Right now and for the last 5 years, pre-earnings momentum has worked, and it has worked marvelously. And if we look at the NASDAQ 100 and look at buying a call 7 days before earnings, but avoiding the actual earnings event, we can see the winners. Microsoft, Nvidia, all the way down. The recent run-up in stocks might mean that the market is like a coiled spring, and that means it may pop yet higher, or it could go lower, and that makes for an opportunity. Today we look at a different approach. The idea that whether there is good news or bad news from tech earnings, that stocks may be set up for a wild ride right after the event, and we don't care if it's up or down. So we'll look at the NASDAQ 100, but this time we'll look at the 7-day post-earnings straddle. So owning a straddle after the earnings event and not taking earnings risk. We can see that Google has the most wins over the last 3 years in the entire NASDAQ 100. But let's go a step further. We'll tap on the ticker. While just owning the volatility has been a winner, it's fair to ask, could we improve the backtest results if we also sold some options against this long straddle? And that is called an iron condor. Now let's look at those results. So we'll change our strategy from a long straddle to a long iron condor. Here's the iron condor, and at first blush, we actually see the return goes down. Let's try something a little cleverer. Instead of buying the at the money options, the 50 delta, let's try slightly out of the money options, the 40 delta. We'll go into settings and select 40 delta. Now we see 550% returns going up to 736% returns, leaving our win rate the same. And in fact, these trades risk less than were risked in the long straddle. So this backtest adjustment has increased returns by nearly 40% and reduced risk by nearly 50%. Thanks for watching.